Passive investing works for one reason. It rides the long-term upward drift of markets. Buy broad indexes. Reinvest dividends. Minimize fees. Wait. Historically, that has worked. But worked in the past and works in all conditions are not the same thing. Passive investing assumes three things: that markets recover quickly, that investors can hold through drawdowns, and that time smooths risk. Those assumptions are usually true. Usually. Let's start with the math. Indexes go up over time because they are self-cleansing. Failing companies are removed. Growing companies are added. The index never holds losers forever. The investor does. This creates a structural upward bias. That's why passive works. But now look at volatility. A 20% drawdown requires a 25% gain just to break even. A 40% drawdown requires 67%. A 50% drawdown requires 100%. Those are not symmetrical moves. Passive investing assumes you can absorb these drawdowns without changing behavior. Most people can't. Not because they're weak, because they're human. Now consider sequence risk. Two investors can earn the same average return and end up in very different places. If large losses happen early, especially during accumulation or early retirement, compounding breaks. Passive investing doesn't manage sequence risk. It ignores it. That's fine in calm markets. It's dangerous in transitions. Next problem, concentration. Indexes are diversified by name, not by exposure. At various points in history, energy dominated, then financials, then tech. Today, a handful of companies drive a disproportionate amount of index returns. When concentration rises, passive becomes a momentum strategy, whether you realize it or not. Momentum works until leadership changes, and leadership always changes. Now let's talk valuations. Passive investing doesn't care what you pay. It buys at any price. Low valuations forgive mistakes. High valuations punish patience. When future returns are pulled forward, long-term averages don't protect short to medium-term outcomes. Passive still works, but the wait gets longer. Much longer. Another assumption: liquidity. Passive works best when flows are stable. But when money exits indexes, it sells everything, good companies and bad ones alike. There's no discretion, no judgment. That's efficient on the way up, brutal on the way down. So when does passive stop working? It doesn't fail permanently. It fails temporarily, at the worst possible time, during regime shifts, during inflation shocks, during valuation resets, during prolonged sideways markets. And those periods don't last months. They last years. Passive investors who can hold through that are rewarded. Those who can't sell at the exact moment the math turns against them. So here's the truth. Passive investing is not a strategy. It's a behavioral contract. You're agreeing to underperform during bubbles, do nothing during crashes, wait through stagnation. Trust long-term averages over personal timelines. If your timeline is long enough, passive works. If your timeline is fragile, it doesn't. That's not an argument against passive investing. It's an argument against believing it's risk-free. Because the risk isn't volatility. The risk is time.